An endowed chair at Princeton University sends around some sort of ridiculous fudster stuff that says there's only 7 transactions a second, and each transaction takes as much power as a family home. Okay, what a friggin' moron. Okay, if he even thought for 2 seconds about what he sent around, he'd realize that it's impossible to have that much power in the world, let alone that much power generated for the Bitcoin mining.
Hello and welcome back to the Daily Crypto. We have Greg Foss as he shares his views on the concept of power generation for the mining space in Bitcoin and the arithmetic behind power sharing in Bitcoin mining. Before we get into the conversation with Greg Foss, if you love this video and want to see more interesting content about happenings in the crypto space, please like and subscribe to our channel. Let's dive in with Greg.
An endowed chair at Princeton University sends around some sort of ridiculous fudster stuff that says there's only 7 transactions a second, and each transaction takes as much power as a family home. Okay, what a friggin' moron. Okay, if he even thought for 2 seconds about what he sent around, he'd realize that it's impossible to have that much power in the world, let alone that much power generated for the Bitcoin mining network. Bitcoin mining takes 0.5% of all total power generated in the world. Yes, it is bigger than some countries, but quite honestly, it's way more important than some countries as well, right? For freedom and security and everything like that. Just look at the mathematics. So Q, the thing that bugs me the most is people who send out this drivel without even considering the mathematics behind it. Okay, every single Bitcoin transaction takes as much power as a single family home. If the guy thought about that for 2 seconds, he would realize that's impossible mathematics. Yet, this is what they do. They send out this stuff because some misrepresented engineer is just sat down and, got a 0 put in the wrong place, right? It's like, not understanding that 21 million Bitcoin is 21 million Bitcoin, regardless of the fact that there's 8 decimal places, 8 digits on the right-hand side of the decimal place.
Greg Foss is concerned that the arithmetic inexperience of these so-called professionals and deficiency of the populace in mathematics is a major contribution to the general failure in the Bitcoin mining sector, especially concerning the generation and sharing of power.
This guy doesn't understand math, yet he has this designation called CFA, Chartered Financial Analyst. Well, no one should listen to him because finance is all math. The funny thing is, it's like the pizza. If we can divide one pizza into 100 million pieces, we can feed the world. What kind of silly mathematics is that, right? If you don't understand the difference as to what digits appear on the right-hand side of a decimal point versus the left-hand side of a decimal point, you should not be a CFA. You should not be a Prime Minister of Canada. You should not be an economics professor. But there are plenty of those in all sorts of nations that don't understand math, and this is really unfortunate.
Foss thinks that professionals in the field need to properly learn the core basics of finance and mathematics, as both courses are the fundamentals for properly dispensing skills in financial analysis, especially in Bitcoin. He believes it is easier for engineers to comprehend the arithmetic in the Bitcoin space than other professionals who claim to be finance experts.
People are very poor at mathematics. It is endemic in our population, and so that sort of stuff drives me crazy as an engineer. Engineers tend to get this quickly. Why? Firstly, the law of conservation of energy applies everywhere. And secondly, and most importantly, engineers are comfortable with math, where most of the population, their eyes glaze over when you start talking math. And that's unfortunate because math is the base layer of language, which means most people are illiterate to the base layer of language.
According to Foss, we learn how Fiat Ponzi works because it helps us avoid bankruptcy by balancing our loan value and calculating the percentage of loss, which occurs daily in the commercial banking sector. In addition, he gave situations where these loans have resulted in huge debts to the economy.
1988, when I started my career, Latin American debt. 1998, because of the long-term capital management, okay? A Nobel Prize winner who was running long-term capital management and selling insurance to the street, and they were 100-to-1 levered. It's like people didn't do any math. They were buying insurance from an insurance company that was 100 times levered to its capital base, and they thought it was fine. That's part of the Fiat Ponzi. Wall Street was rescued. Losses were socialized because nobody did the math as to the reality of long-term capital management. You could say, oh, the guy's a Nobel Prize winning professor. He must know what he's doing. No, he didn't know what he was doing. And he brought Wall Street to its knees. That was the second one. The third one, the great financial crisis. Everyone was insolvent. Everyone. And the TARP, Troubled Asset Relief Program, which the Fed printed $700 billion to rescue the system. Guess what? The last and final one was COVID. They printed trillions of dollars, multiple times what they printed to rescue Wall Street in the great financial crisis. That's where we are. Learn that fiat is the Ponzi, people, and successive financial crises will happen more quickly. They'll happen with greater severity.
He went further to stress the importance of Bitcoin opening that the banking industry is most likely entering a crisis in finance, which is likely to cause a fall, and all the regulations of the government would not solve the problem, which brings us to just one solution, and that is Bitcoin.
All paths lead to Bitcoin, okay? You bankrupt the country, your dollar's worth nothing. You print QE infinity, your dollar's worth nothing. You need to hedge the fact that your dollar is worth nothing under all scenarios. But they'll keep printing it as long as people think that's the solution. And that is the Fiat Ponzi. You need to understand that 21 million decentralized math and code is a thing of beauty. And that is Bitcoin. It solves a lot of stuff, including intellectually challenged economists that don't even know mathematics.
According to Foss, if urgent steps are not taken, we are likely to lose the global status of our currency, and maybe other economies in the world may snatch it off our feet.
But if you don't start smartening the fuck up, you will lose global reserve currency status. Global reserve asset status of US Treasuries is already gone, okay? You've seen global reserve banks, central banks, take their US Treasury holdings from 72% of reserves down to 59%. Guess where it's going, people? It's going lower. The US Treasury as global reserve asset, US Treasury bonds, it's over. What's going to replace it? My opinion, Bitcoin, if you guys get your head out of your ass. But I don't care. If you guys don't, other countries will. Maybe we should all start learn to speak Spanish, because South America seems to get it.
The evolution of Bitcoin has touched various regions of the world economy. Regions like the Middle East and even Africa have started to adopt Bitcoin. But according to Greg Foss, however, the United States managed to buy Saudi Arabia over by making them trade their oil with the US dollar. Still, the region that is likely to have a hedge above the US dollar is South America. He believes that the US population has more access to the US dollar than the rest of the world, which he believes the US government should get a hold of faster than later. Generally, he went further to discuss the effect of some other coins in the crypto market on Bitcoin.
And you know, people got uncertain and come along the Celsius network. Again, another poorly designed DeFi protocol that should never have gotten out of the gate, save for funding from stupid Canadian pension funds like the Caisse de dépôt et placements Québec that funded their Series B round. But God forbid they should own any Bitcoin, right? So these are the idiot Canadian pension managers that put money into the Celsius network seed capital round. Anyway, you get what you deserve. If you don't do your research, you get what you deserve, which is a bagel on the value of your seed equity. But the reality is this second punch coming in quick succession to the first punch, Luna, knocked Bitcoin down again. TikTok next block. Here's the funny thing. It's keeping working. The health of the network is identified. The DeFi protocols will all fail. Those aren't my words. Those are NYDIG's words. Every single DeFi protocol that exists right now is at high degree of likelihood of failing. This is healthy for the Bitcoin network long term. Short term, you got contagion effects and systemic risks just within the so-called crypto universe. You know what? There's $1 trillion of crypto assets in the world right now. 1/2 of them are in shit coins. A lot of those shit coins are going to fail in the short term. There will be some potential pressure on Bitcoin.
In recent times, Bitcoin has experienced a huge crash in price range and some lapses in the general crypto market, which has caused a lot of people in the media space to spread rumors of a final crash in the crypto ecosystem, which has caused a lot of us in the crypto space to venture into investing in some other coins. Foss has a few things to say on this. Let's hear him.
Why would I buy a Bitcoin at $24,000 when I can buy the shitcoin XRP at 32 cents, right? Like, whoa, XRP's got to be cheap because it's trading at 32 cents. Again, failed mathematics, failed concept of market cap versus utility versus unit trading price. So it's going to be a hard lesson. It's like penny stocks are never going away. They're never going away. It doesn't mean you should go out and buy every single penny stock. No, it's the same thing with digital assets that you know, oh, I'm the better blockchain. Well, yeah, you are until you aren't. But you know, you can always sell hope and a prayer in a capitalist system, particularly when you have founders tokens and all this bullshit that incentivize people to go out and promote the new, latest, greatest DeFi. But let's move it to the economic level right now, okay? This is important because financial assets in total are melting down as well. Why are they melting down? Leverage is being removed from the system. Quantitative tightening is removing the amount of bonds that are being purchased by the various central banks around the world, and they're trying to fight inflation.
The situation of things, however, has warranted the Feds to think of some particular solutions. Foss has this to say on the Fed's approach to the rising inflation.
So the Fed is trying to react to that by raising short-term interest rates. They've done two. They've done 2 short-term interest rate increases, and the stock markets are off more than 20% year to date. That's $20 trillion of global wealth that has been destroyed just because of rising rate environment and removing the stimulus, either fiscal or monetary stimulus, from the system. We've only done 2, and they're anticipating another 14 equivalent rate hikes of 0.25% or higher. Right now, they're jawboning in the Wall Street Journal, which is leaking this stuff, and their stupid jawboning reporter leaking this stuff on the front on the behalf of the Fed. Oh, they might do 75 basis points to work that into, you know, not surprising the markets. Well, heck, you're surprising them because you've done such a horrible job of managing inflation. Inflation didn't decrease last month; it actually increased. And if you measured true inflation, it's much closer to probably 15% annualized than the 8.6%.
Greg Foss also shares with us the idea behind taking wealth risks in crypto and putting up large investments in bonds and Bitcoin. According to him, we must learn to manage risks. And he doesn't hold most of his investments in Bitcoin, but he has this to say.
I am a diversified risk player, okay? What does that mean? By being a good risk manager, it doesn't mean putting all your wealth in one risk bucket. You need to diversify your risk buckets because you have to manage risk through probabilities and expected values, okay? And this is why I love Bitcoin so much. Some of the Bitcoin maxis say, Foss, if you love Bitcoin so much, how come you're not 100% invested in Bitcoin? And the answer is simple. Bitcoin's the best asymmetric return opportunity I've ever seen in my life. I don't need to be 100% in order to reap the rewards of the upside, okay? So again, this is a personal portfolio allocation that you need to determine for yourself. So bonds right now are the worst risk reward opportunity I've ever seen in my life, and I've been managing and trading bonds for 35 years. Okay, I own 0 bonds. In fact, I'm short bonds right now. Okay, why am I short bonds? Because I'm borrowing money. By borrowing money, you're effectively short bonds, okay? Because right now it pays to be a borrower, not a lender.
What is your opinion about the fiat scheme coupled with the Fed's reaction to the ongoing inflation? Do you see us hitting bottom soon? Kindly share your views in the comment section below. Do not forget to like, share, and subscribe to this channel for more interesting topics in the crypto market. This is the Daily Crypto. See you in our next video. Until then, stay safe.